Welcome back to What's Hot, What's Not, C.R.E. for Wednesday, February 25th, 2026. You're listening to episode 48. Today we're diving deep into the number one metric on every investor's dashboard, the 10-year Treasury. It's the baseline, the benchmark, the number that dictates the cost of capital and shapes the landscape of commercial real estate. So what is it signaling for the year ahead? Let's break it down. So, what's hot? Stability. For the first time in what feels like ages, we have a degree of predictability. The 10-year Treasury is sitting at 4.05% today. Now, that number itself isn't the whole story. The key is that it's down 17 basis points over the past month and 21 basis points year over year. More importantly, it has been trading in a relatively tight range for several months. This is the stability window the market has been desperately waiting for, and capital is responding. Deal velocity is picking up significantly. Transaction volume is up a solid 16% year over year, and we're on pace to hit $562 billion in volume for 2026. That's nearly matching pre-pandemic levels. The bid-ask spread, that stubborn gap between what sellers want and what buyers are willing to pay, is finally narrowing across most asset classes. Liquidity is returning, albeit selectively. We're seeing cap rate compression as a direct result. C.R.E. is projecting 5 to 15 basis points of compression across most property types this year, with industrial and multifamily, as expected, leading the charge. The spread over treasuries remains attractive, offering a compelling risk premium for investors. And here's a real sign of life. Even the beleaguered office sector is finding a floor. Office sales have surged an incredible 52% from their trough. Make no mistake, it's still a challenged sector. But this activity suggests that opportunistic buyers see value and are willing to place their bets. Now for what's not so hot. The Federal Reserve. They are firmly on pause, holding the federal funds rate steady at 3.5 to 3.75% after their January meeting. The meeting minutes revealed that some officials even discussed the possibility of raising rates again if inflation proves too sticky. The market has gotten the message loud and clear. Gone are the days of pricing in multiple rate cuts. J.P. Morgan no longer expects any Fed cuts in 2026. Goldman Sachs and Barclays have pushed their forecasts to September at the absolute earliest. And this brings us to the elephant in the room, the wall of maturities. $1 trillion with a T. $1 trillion in commercial real estate loans are set to mature this year. Many borrowers who underwrote their deals in 2021, when rates were near zero, are now facing a painful reset. Refinancing at current rates is going to be extremely difficult for overleveraged deals, and we should expect to see more distress and forced sales as a result. So, why does all of this matter? It signals a fundamental shift in market psychology. The market has adjusted. We are no longer in a holding pattern, waiting for rate cuts to make deals work. A new equilibrium has arrived. That equilibrium is a 10-year Treasury in the 4% range, all-in financing in the 5 to 7% range, and deals that have to pencil based on solid fundamentals, not on the hope of future Fed action. Predictability, it turns out, matters more than the absolute level of rates. This stability is the key that is unlocking capital that has been sitting on the sidelines for the better part of 2 years. So what's the investor takeaway from all this? It's simple, really. Underwrite your deals at current rates. Do not bank on Fed relief to make your pro forma work. A 4% 10-year Treasury is workable. Deals that pencil today, based on today's cost of capital and realistic rent growth assumptions, are the deals to pursue. The waiting game is officially over. It's time to get to work. Thanks for tuning in to What's Hot, What's Not, C.R.E. We'll see you tomorrow. And don't forget to like, share, and subscribe wherever you get your podcasts. For more insights, visit hotnotcre.com to learn more and subscribe to our daily newsletter.